I'll just reintroduce myself for the moment. My name is Erik Schatzker. I'm an anchor and editor-at-large at Bloomberg Television. It's been my pleasure to be your MC yesterday and today, but now it's my turn to sit in the comfy chair. And it is my pleasure to introduce Jes Staley of JPMorgan. I will give you just a very brief rundown of Jess's resume, so those of you who don't know him well get a better sense of his credentials, which are significant. He is the CEO currently of JPMorgan's investment bank, and he's a member of the operating and executive committees. He is not one of what you might call Jamie's boys. He joined JPMorgan, the old JPMorgan, back in 1979. He worked in the Latin American division for quite a long time, including a stint of 8 years in Sao Paulo. He also helped to found the equities business for JPMorgan back in the early 1990s. He worked in private banking from 2001 to 2009. This is really where Jess made his reputation at JPMorgan. He ran JPMorgan Asset Management, and he led the purchase of Hybridge Capital Management in 2004, which was completed last year. And it is my pleasure to welcome Jess to the Bloomberg Markets Hedge Fund Summit. Jess, thank you for joining us.
Thanks, Erik.
All right, let's get going with the questioning. This is a hedge fund summit. We're going to talk plenty about hedge funds. We're going to talk plenty about Hybridge, but we do have to clear away a couple of issues that are outstanding, shall we say, for the banking industry, and which I know everybody here would like to ask if they were in my shoes. So let's start with this. Last week, those Goldman Sachs hearings in Washington thrust into public view a fierce, you might call it a fierce and escalating debate. On the one side, you had a firm, but also representing an industry that believes, you'd have to say, there was, and perhaps still is, nothing fundamentally wrong with its business model. And on the other hand, you saw politicians of every stripe channeling, you might say, the popular view that banking is rife with irreconcilable conflicts and cheats its clients. We heard lots about that. And it does feel to many of us as though we are looking at banks through a new lens. So my question to you is this a new reality for American banking?
You know, I think the introspection that is going on in the financial industry is healthy. I think the discussions in the public forum about the role of banks in society is a good thing. But I think all established institutions realize that the most important asset they bring to their clients every day is their reputation. And I was asked the other day, you know, what keeps you up at night? And my answer was not the balance sheet of JPMorgan's investment bank, but rather the reputation. And we have 24,000 people around the world, and their actions and how they deal with clients, how they deal with others in the firm, how they deal with regulators is critically important. So reputation is something we all need to be focused on. And I'm sure the people at Goldman, as well as the people at JPMorgan, realize how we comport ourselves is critical to maintaining the reputation that's important for our institution.
Does this call for a redesign of the business model? And if the banking industry does not respond to that challenge, will this be its Waterloo?
I think, again, the industry needs some introspection. And I think the work going on in Washington in terms of changing the regulatory environment needs to be done. I think you'd be ignoring what happened in 2008 to say otherwise. And I think a lot of good constructive dialogue is, in fact, going on down in Washington. And hopefully we come with a new regulatory framework that allows us to avoid a repeat of what happened in 2008. But, you know, finance in many ways is the oxygen for commerce. We have a very strong global economy. The interconnectedness of that economy, I think, was very apparent over the last couple of years. And a robust financial community is critical if that commerce is going to occur. When you listen to the two government officials before us, you know, if Europe is going to address the challenges that it has, it's going to have to grow. And you cannot grow an economy either on a national scale or a global scale without a robust financial market. So the basic role of finance of providing the oxygen for commerce, I think, is not going to change.
You mentioned just a couple of moments ago the importance of reputation. Reputational risk has become a fashionable term, but until 2.5 weeks ago, we really had no idea what reputation was worth. Now we know, 22% of market cap. Had you at JPMorgan ever put a price on reputational risk before we saw what happened to Goldman Sachs, and how has that experience changed your discussion?
We've had reputational risk committees at JPMorgan for years, so long predating the current situation that we're in. I've been in the industry for 30 years, and there have been other instances where established firms got in trouble as a reputational matter and paid a very serious price for it. So we have taken it as an important consideration to us for a very long time. This notion that that is our greatest risk is not new, at least to me, and I don't think it's new to the people of JPMorgan. We have to be constructive participants in the global economy, constructive participants in society overall. And so how we are, trust is extremely important in this business, and we have to invest every day in the trust that our clients put in us.
Jess, I'm not going to ask you a question about succeeding Jamie Dimon because I know you won't answer it, so I'm going to ask you to do something better. Think like Jamie. How do you operate in an environment where it doesn't matter if you did anything legally wrong?
I've always judged a banker. People make mistakes, and people make mistakes in judgment. But there's a difference between a mistake in judgment and a mistake in principle. And what I would hope is that we hold ourselves all to a level where principle is non-negotiable. But we are human, and I don't think you want fear of prejudgment to curtail innovation, to curtail creativity. So I hope that this industry stays true to the principles which build trust, but also give some latitude that sometimes people do have mistakes in judgment.
Let's accept for a moment that we are dealing with, call it a new reality in banking. If you look at the range of JPMorgan's businesses, and we're moving closer to hedge funds here, what businesses become of questionable value or potentially pose unacceptable risks under that scenario?
I don't, again, there should be no business which challenges the basic principles of integrity and fairness and transparency. So I don't see any business right now in the context of JPMorgan that I think challenges the principles of our firm. In some markets you are a fiduciary, in some markets you are an intermediary, but I think you always need to live by that principle that having the trust of your clients is core to the reputation of your institution, and that's got to be preserved at all costs. And I don't see any business that we do today that has some sort of structural conflict with those principles of doing the right thing and being transparent.
All right, in that context, where does Hybridge fit in, and how does Hybridge's role at JPMorgan differ today from the way it would have been, say, 3 years ago? The president of Hybridge, JPMorgan has managed client assets as a fiduciary for over 100 years. Whether it's an endowment, a state pension fund with firemen and policemen's assets there, or high net worth individuals or consumers. We have managed for years and years and years those assets as a fiduciary. What we saw in Hybridge is we believed that the traditional asset management industry accelerated its evolution over the last decade and moved into the alternative space. And managing client assets as a fiduciary in a relative value trade is as important today as managing fiduciary assets, buying stocks and bonds were 20 years ago. So we saw Hybridge very much as simply a product extension of a traditional asset management business that has served JPMorgan and its clients very well for decades and decades. All I think that's transformed in the last couple of years is I personally believe that the hedge fund community has come out of these 2 years almost in a stronger place than they did going in. I think when people look back to 2007, 2008, and 2009, the returns of the hedge fund community overall versus the volatility of those returns or versus the risk,
I think have held up pretty well vis-a-vis other asset classes. And today, Hybridge is as important to JPMorgan, if not more so, than it was 3 years ago.
I just want to pick up on a point you just made because it struck me. The hedge fund business is stronger now than it was before the crisis. How do we explain that, given what we've seen from so many funds? Gates, forced liquidations. A lot of people would look at the hedge fund industry and say that in many cases, it has been an embarrassing 3 years. And I know a number of institutions who certainly feel that way.
There are clearly lessons that we have learned in the hedge fund space. I think probably the most important is too many hedge funds took on positions that had liquidity profiles that were very different than the liquidity profiles that their investors had, and that created a mismatch that was caused some problems for the industry. Taking that aside, however, people went into the hedge fund space saying this is an investment strategy which won't lose money, and that's just a proposition that no one should carry into this business. And so there was clearly disappointment when a number of hedge funds, including Hybridge, had some quarters where our returns were negative. But then when you sit back and look at the other asset classes and you take your overall portfolio and you look at what happened with the stocks that I owned, and they were off 50 or 60%, and you compare those returns to what you've seen in the hedge fund space, and in hindsight, I think against other asset classes, the hedge fund community has come out actually quite well.
Just a couple of moments ago, you made the case for why a bank like JPMorgan should own a hedge fund manager like Hybridge. What about the negative synergies? Wouldn't JPMorgan, for example, be able to generate $250 million in fees if Hybridge were spun off as a standalone unit? And also you talked about the role of the fiduciary. There are conflicts inherent between asset management, commercial banking, investment banking, and at the very very least, those questions come up and you have to constantly explain them. How do you reconcile the negative synergies?
Well, given the current discussions that are going on, it hopefully is not ironic that in the real Glass-Steagall of 1934, the asset management business run with a fiduciary mindset was not seen to be a conflict with commercial banking. So hopefully the wisdom of those days prevail. We have very rigid walls that separate the investment bank of JPMorgan with how we manage client money as a fiduciary. Throughout the crisis of the last couple of years, I think one of the things that you would have to comment on is those fiduciary walls, I think, have served the industry very well and have served investors very well. Going back to your point about reputation, acting as a fiduciary asset manager, be it in a mutual fund or a hedge fund, is probably an activity which requires the greatest amount of client trust. For an endowment or an individual to come into JPMorgan, come into Hybridge, give them our money, give us the latitude to invest that money how we wish, takes an immense amount of trust. So there would be no business more damaged at JPMorgan if we violated that trust by violating our fiduciary responsibility than Hybridge or JPMorgan Asset Management. So doing it well, I think, reinforces very much the core value proposition of JPMorgan as a whole.
Hybridge chose to be acquired by JPMorgan. Other hedge funds chose to go public, not too many, but they've turned out to be pretty lousy investments for public equity holders. Fortress IPO'd at $18.50, trading at $5. OXIF IPO'd at $32, trading at slightly more than half that. Is there a valid argument for hedge funds to go public today, given current valuations and the burdens that a public listing imposes?
That's a very good question. One, I don't have the insight to make a judgment as to whether an IPO is a good exit vehicle or not. I would say if the owner of a hedge fund finds a value level that is attractive to the buyers in the broader market and they can cross at a valuation which makes sense to both of them, that's what the market is all about. And if that can occur, then I think an IPO is a justifiable transaction for a hedge fund. The challenge is a significant component of the revenue of a hedge fund comes from the performance fee of managing your client's money. And most people who own a hedge fund would like to see in the valuation of that hedge fund some multiple on that performance fee. That's a tough thing to do. To pay a multiple on projected future performance is a very tricky thing to value. That's the basic difficulty, I think, in taking hedge funds public. But if you can find a valuation that satisfies both parties, clearly it can work. Hybridge chose a different alternative, but make no mistakes, JPMorgan is a public company. So at the end of the day, you could argue Hybridge through the back door IPO'd itself. So I think it's a function of the market and the time. I think all the companies that go public want their shareholders to do well. I think no one's happy with how those prices have traded, but that's been very much a function of the market and not the performance of OXIF or Fortress.
Jess, I have a feeling I'm not the only person in this room who would like to ask a couple of questions of you. I've got lots more, but I would like to open it up to the floor. If anybody has a question for Jes Staley, please raise your hand and make sure that we wait for the microphone to get to you. There's one right here in the front row. And if you don't mind, identify yourself before you ask the question.
Hi, Jacob Gottlieb from Visium. Jess, can you comment on Volcker rule and likelihood of passage, and if you agree that that's a reasonable partial solution to some of the problems that we've seen in the past?
There is a lot in the regulatory reform bill as currently drafted that we support. So we support a systemic regulator. We support the efforts to not allow any institution to be too big to fail. We support the efforts to make much more transparent the derivative markets. So there's a lot of very positive things going on in Washington right now. There are components of the Volcker rule that I think are constructive as well. The only thing I would say, going back to a point I made earlier, is where we are acting as a fiduciary and where we are managing third-party money. That's an activity that requires no capital of the bank, uses no deposits of the institution, creates zero systemic risk, and in fact, because it is a very separate revenue stream from classical investment banking or commercial banking, drives revenues to the institution, makes the banks less risky. So we think that's a very constructive thing, and we would hope that the Volcker rule, as it goes through the Senate, does allow those activities to continue to occur.
I want to go back to the floor in just a minute, but to pick up on a point you just made, Jess, about supporting transparency, particularly in derivatives, it has been said that banking is opaque for a reason. Opacity equals higher margins. Is there truth to that?
No.
Really? So how do you justify the level of opacity we see in banking then?
I think if there is opacity, and to a certain level, I think there has been, it's to a certain extent the market catching up to the degree of innovation that we saw. I mean, there's been an extraordinary development within the financial markets over the last 10, 20 years, innovating new products, creating the capital markets with the scope and scale that it has, and much of that has been very positive. But like in any activity, innovation and technological development can outpace where we are in terms of management systems, organizational systems, or political systems. And that obviously has occurred here. And that's why I think what is happening in Washington is helpful, because both banks and how they are managed and regulators and how they regulate need to catch up to the innovation and provide the transparency. These markets are so large and important, they should not be opaque. And I know for our institution that is not a goal or something that we aspire to. Quite the contrary. I think we would like to see much more transparency, much more awareness of the risks that the industry has and that institutions may or may not have.
I suspect there are a few people listening who'd like to hold you to that. I want to open it up back to the floor. I did see another hand shoot up. Anybody else with a question for Jes Staley here? Perhaps the question was answered. So I will follow the point that you just made, that what you see in Washington is helpful. After watching those hearings and all the painful exchanges around what a market maker is, I mean, the amount of time that was taken trying to get to the bottom of what market making is struck me, and I suspect struck other people too. How can you and others in the industry, and how should we feel confident that the people who are writing rules for banking aren't going to screw it up?
That is one of the challenges that we face, in as much as the financial markets are complex, they are global, they are extremely important to the functioning of business overall. And as we write new regulations, there needs to be balance. There needs to be a lot of consideration of unintended consequences. These issues are very complex. And I just hope that there is some degree of partnership between the financial industry and lawmakers so that we, in concert, think about the implications of what we're trying to do. And the banks have a tremendous obligation to get this right. But hopefully there's a level of dialogue between the two parties so that the unintended consequences are manageable and don't disrupt the efficient functioning of the financial markets.
Yesterday, right here at the Hedge Fund Summit, Mark Standish, the co-CEO of RBC Capital Markets, was talking about Basel III. And this is a very important component of the new regulations that the industry is facing. He said that Canadian banks, which everybody agrees were relatively well managed during the credit crisis and are well capitalized, would need to increase capital by 20% under the current, what's currently envisioned for Basel III. If that's the case, and I'm assuming that JPMorgan and all of the other banks here would be similarly treated, how's that going to change the return profile for a bank?
Well, I want to compliment the Canadian banks and the Canadian banking system for how they did over the last couple of years. I'm sure there are some lessons for all of us there. I think it's very early to get into concrete issues around Basel III. There are a lot of proposals out there that would have dramatic impacts if they were put into place today. I don't think, or we don't think, that is going to happen. I think Basel III, already people recognize, needs a lot more discussion and debate and go out there. But at the end of the day, the most important thing, I think, is that whatever decisions are made around capital requirements or accounting treatment, that they are applied universally across the financial industry. What we don't want to get ourselves into, which is part of the challenge we faced before, is regulatory arbitrage. That certain regulatory or certain regulators in certain locations have very different rules of the road than other regulators in other locations, or for different parts of the financial industry. And then financial capital will seek the weakest regulator or the weakest market or the weakest industry, and we create this regulatory arbitrage. We don't want that. So I think the efforts of the G20, the efforts going on in Basel, the efforts going on at the U.S. Treasury and whatnot to come up with a regulatory framework that provides a level playing field where capital will be treated universally within the financial markets, that should be the main goal and the destination point that we want to arrive at.
Jess, Jamie has said that anybody who runs JPMorgan needs to understand risk. To anybody here or anyone out there who wants to be sure that Jes Staley understands risk, what do you say?
Well, one, I share Jamie's point of view, and it's an accurate one. And if we take lessons for the last couple of years, not understanding the risk is a very risky proposition in and of itself. There's a great risk management culture inside of JPMorgan. I think our results of the last couple of years bear that out. I'm surrounded by very talented colleagues. There's an openness about the risks that are in the balance sheet of JPMorgan. I think we have a culture of openness and thoughtfulness about managing those risks. As I said, I sleep well at night, and I recognize that one of my principal obligations is to manage the risk in the investment bank. So I feel comfortable about where we are. I think our track record speaks for itself. We always have to be looking for the new risk. I mean, make no doubt, the new regulations will create new risks. If we start to drive a significant amount of derivatives through clearinghouses. There will be risks in those clearinghouses that are new. If we drive business through exchanges, there will be risks in those exchanges that are new. So the one thing you can't do is put your guard down and have to recognize, just like I think we learned in 2008, the risk in 2018 will most likely be something that we haven't thought of today.
Jess, I thank you. Bloomberg thanks you. And I know everybody here at the Hedge Fund Summit, thanks you for joining us. Jes Staley, CEO of the JPMorgan Investment Bank.
Thanks, Erik. Appreciate it.